Hello and welcome to part 4 of the Trading Commodities course. I am Keith Harwood for Option Hotline. Today I'm going to talk about a sector that is near and dear to my heart, and that is the precious metals. I'll get into why after we do our normal disclosures. All services and content are provided for educational and information purposes only and are not intended as legal or financial advice. Before I get into the precious metals, please read this precious content that is designed just to make sure you guys understand what we're doing here today. All right. Hopefully that gave you guys enough time to read the disclosures. Who am I, Keith Harwood? Reminder, I traded precious metals for a number of years through quantitative easing as a proprietary trader and market maker. And after I finished my MBA, I started trading those precious metals for a hedge fund. So I've had a lot of experience in precious metals. One of the things that I really like playing around with is precious metals now is the currency. So precious metals was trading off of quantitative easing and sort of bubbly-like behavior, whatever that was 6 years ago. Now it's much more about the normal currency movements and central banks and things like that, because we're not talking necessarily about the United States printing money as much as we are into quantitative tightening. So if quantitative easing helped create a concern about inflation and a lot of demand for gold. What does quantitative tightening do? Exactly what we've seen now, and that the price has gone down. Add to that concern that people just weren't happy with their commodity allocation performance, and you get the kind of performance we see now where people have kind of put it to the background, but it needs to be considered for a trade. Because those trading opportunities that I discussed last time are where I think there's some real money to be made in commodities, and gold is not no different from that. So I'm going to do a little bit of discussion on central banks before I get into the big idea here, in that these things are very correlated to the yen. And you'll see a little bit why, and I'll talk a little bit why they're correlated, and then you guys get to see the results that this idea generates over time. Okay? So let's think about what gold and silver really trade off of. Currencies, risk on and risk off behavior. It's not really driven by jewelry demand. Yes, that demand for jewelry is there, but it's always there. It's always about the same amount. It's not like people go out and buy a ton more jewelry. They don't buy extra wedding rings just because the price of gold comes down, because the precious jewels, the diamonds, the sapphires, and everything else, that's a bigger price component to a lot of jewelry. So where is it really coming from? It's coming from that investor demand for an inflation protection asset, or concern about risk on and risk off in what the central banks are going to be doing. Central bank policy drives bonds, currencies, and commodity price action. So the way that central banks operate is they, part of their operation is to determine how much money is in the system. So if they print more US dollars, that reduces the value of the dollar and increases the value of things you can buy, or increases the cost of things you can buy with a dollar. That's that inflationary element, right? So if there are more dollars in circulation, but there's not more gold in circulation, then gold is worth more in dollar terms. What we see a lot is that a lot of this money printing is, it's been, yes, there was a ton in the United States. There's a lot in Japan as well. And the yen has been sort of a safe haven for currency because of that. So we see that when people are scrambling for risk, they oftentimes are putting that money into the dollar and selling the yen, and vice versa. They'll buy the yen and sell the dollar when they need a little bit more protection, because they know that the central banks in Japan are going to help protect that investment. So that's like sort of one of those risk-off behaviors. It's not as automatic as, say, going into the VIX, but it operates similar to the bond investing that we often see, where people are looking for a safer investment, they go to bonds, or a safer investment, they go to Japan. Okay? So, with that in mind, let's take a look at the yen and gold. So, over time, you can see that there's a pretty strong correlation here. When the yen gets stronger and the dollar gets weaker, these go hand in hand. The unique thing about the yen is it doesn't always trade So the dollar yen comparison doesn't always trade hand in hand with the overall dollar index. So there are times where the dollar is strong, but it's weak against the yen, or the dollar is weak, but it's strong against the yen. I want to point out a couple things that have gone on here, and this is one of the things that means that it's not always a perfect system, is that you get deviations, right? So the normal thought process right around here is that, the yen should have seen gold drop a little, and it dropped a lot. And then when it started to recover, gold just like snapped right back in there. Well, where are we right now? Gold has really underperformed. Are we going to repeat this kind of behavior? How long does that snapback take, though? It can take a few months. So there are a little bit of trading opportunities in there, but these are the big ones. The snapbacks can really capture a lot of profit if somebody's positioned the right way. And particularly if somebody uses options where the leverage is there. And we can capture these big washouts even when they're below. I mean, I know I was long puts here. Here, June. I was long puts here. These moves, though, over time tend to snap back together. So one of two things is likely to happen in the coming months, right? And that's either that the yen is going to weaken or gold and silver are going to strengthen. Because we only trade so far below for so long. Here was a big differential here, right? What happened? The yen came down. Dollar got stronger against the yen. So it's not always that this gets the snap back in one side or the other. Just something to be aware of as we focus on creating that trading system is that it's not always the easier to trade to make. So it's easier to trade in gold and silver, the ETF, because it's the one that tends to lag the yen's move. Or sometimes overshoot and need a snapback. But it's not always the case. Silver's the same. Very strong correlation. It's actually overshot to the upside as well as the downside here. But again, really, really cheap looking relative to the yen on a historical basis. So what's the next move here? Well, if we see any signs of inflation, maybe, just maybe, this stuff can come back with gusto. And so if this is all going to start getting exciting, because people get excited about precious metals and commodities when they're going higher, not when they're going lower. That stuff's going to get exciting, I think. And that's why I want to make sure that I've got my trading system in place so that when this happens, not only am I back in the game when silver's up here at the recent highs, I want to capture that move on the snapback. And if that doesn't happen, I'm still looking to make money on these little moves day to day. This sort of stuff maybe is more chop, but you see these little trending moves that you can see happening in silver? Up, down, up, down, up, down, and they're happening with the yen. Up, down, up, down, up, down. There's money to be made there if you can recognize that sort of trend and figure out the signal of when dollar yen is flipping trend. So what do? I look for a signal from dollar yen. So I have two assets that trade in tandem. I just showed you that, right? So I can construct a trade. That's the next stage of it, right? Say, okay, well, if these things are going to trade relatively in tandem, I can make money off of that. So then I use the technical signal from one asset to predict the price action in the other. So I'm going to use a technical signal in dollar yen to predict the price action in gold and silver. Now, it's a proprietary signal, so I can't give you guys the exact details, but I can tell you that it's based upon simple trend rules, right? So it's go back to the trend signals course, the trend trading course, take a look at some of that stuff. You may be able to try to figure it out yourself. It's not aggressively complicated to do, but it compounds and it makes money while commodities investing just doesn't. I mean, you can see normalized price action in gold. It's up 6-ish% in 3.5 years. I mean, that's not a good yield relative to the stock market. Silver is up 6-ish% in 3.5 years. Why would I pay for that kind of return when the market is going to give me a lot better? The benefit of diversification is just not sufficient. Sorry, that's the yen that's up 6%. Silver is down 10%. Gold is unchanged. So we've got two commodities that are not moving or actually negative over that time period, even though they provide a diversification benefit. They don't provide any money to me. So I trade. And if I generate a trading signal like I'm talking about using a momentum signal in dollar yen and apply that flipping trend signal to gold and silver, which delay their move behind the yen, you can generate relatively consistent results. Yeah, you get some times to chop. 10% wiggle between 10 and 20% return here. But then you get this nice long trends. Like most of 2017 was a really good trend there for about 7 months that generated returns of about 40 to 50% in a portfolio without leverage. This is without the options leverage. This is just taking the money that I have. If I have a $10,000 account and saying I'm either going to be long $10,000 worth of gold or short $10,000 worth of gold, depending upon my signal. So without leverage, I can generate returns from nothing. So in 3.5 years, this signal is up almost 60%. This is excluding commissions and fees, and that's important to remember. Excluding commissions and fees, because everybody has different commissions and fees. So the returns, though, are there. So why not trade instead of invest? And if I do it in silver, it's 80% in 3.5 years. That's good. That's better. That's much better than gold or silver as an independent investment. Frankly, it's a great way to pair with an equity investment. Because equity investments have been performing really well. But if I can use a trading system, a trading approach to the precious metals to generate similar, if not better, returns, why wouldn't I do that as a way to complement and diversify my portfolio? So let's think about an example here. If I think that the dollar yen is going to trend up, what do I expect in gold, in GLD? Will that go down, up, down, or I have no clue? So dollar yen is trending up. I'm going to show you this, and then you're going to tell me I tricked you. I expect it to go down. This graph is the yen over the dollar. I asked about the dollar over the yen. So it was a little trick, but generally speaking, if the dollar is strong relative to the yen, that is bad for gold. Gold goes down when dollar is strong. Dollar up is a negative move for gold. This is shown the other way to show you guys the strength of that correlation. So again, if the dollar is strong, then gold should get weak. Next time I'm going to talk about oil. It's a different kind of signal. I don't use currencies to signal my oil trading. I use more direct technical signals straight into oil. So we'll talk about that in the next section. Thanks, guys.